The markets are deciding they do not like what Powell said, and tough. I mean, I'm sorry, you didn't think that he was going to stick by the "we have more work to do"? Let's pull out the home builder stocks right now, because they are currently slumping just minutes after Chair Powell wrapped up his conference and said that the housing market was overheated before rate hikes began and still needs to get back into balance between supply and demand. Now, we know that certainly housing prices have come down, mortgage rates skyrocketing, but let's stretch it out to the look at how the broader markets are reacting to Powell's words and where the best investment opportunities, if any, are at the moment. To our floor show, U.S. Bank Asset Management Group CIO Eric Friedman, who's got $391 billion in assets under management, and Carnivore Trading CEO Dutch Masters. Eric, I will begin with you. Where do you invest after hearing what Powell just said?
Yeah, Liz, we would retain that cautious viewpoint we've had for some time now. And I think that really the way you want to invest is to be in more short duration bonds. That's a place where we still think there's the opportunity to preserve some capital. In the equity market, we still think that being involved in energy makes sense. That's the one sector that has a really good fundamental setup. You're just not seeing companies out looking for oil at the level they need to. And so we think that energy makes a lot of sense. We'd be a little cautious still on technology. It's not the time to get overly aggressive. We certainly get it. A lot of those stocks have already moved lower. We'd still be a little more defensively positioned in the current environment.
Technology, Dutch, I know what you're going to say, but it's like I need to throw the gigantic filet mignon to the carnivore. Where do you stand on technology? For a minute, the SOX index, the chip basket of stocks, semiconductors, popped up about 2% and then lost it all pretty much. We have seen Amazon and Meta hit brand new 52-week lows. What's your thought on tech?
So I feel like I'm on Groundhog Day here with Bill Murray. I mean, the last time we had the Fed come out and do their thing, the market spiked and then it crashed. So we're just seeing it all over again. We have a very interesting outlook on tech. The large mega cap stocks we think are really struggling. We think there's a major rotation out of those stocks and into other stocks. We like how financials are looking, especially insurance companies. We bought Aflac and we bought W.R. Berkley, and these are blue chip, multi-billion-dollar market cap companies. They're going to do better with rates. We like how biotech is acting. It looks like it's breaking out of a decades-long base here, but I have to tell you, the mega caps are just struggling, and I think that they're dead money for a while.
Dead money. Well, then what isn't? What's alive and kicking for you?
Well, we like in the tech area, what's alive and kicking is really things like GFS, which is, a chip maker that is insulated from any of the geopolitical problems potentially in Taiwan and China. And then we also, like I said, we're flowing into the insurance area. We're looking for stocks like Bandwidth, which announced last night. We bought that pre-market and in the open. This is a company that's down 95% from its high in 2020, but it's a real company that does $500 million in revenue and has, positive EBITDA.
Well,
and so it's going to stick around. And our mantra is, if a company's down 95% from its high and it hasn't gone away yet, you've got a really good shot at a nice run on a recovery trade.
Brian, markets react to changes and comments from the central bank like pretty much nothing else, don't they? Where do you feel once this moment in time passes through, because he made it very clear we are not done raising interest rates, but when we finally do see a pause, do you expect a hyper-dramatic snapback, some kind of spring-loaded moment where the stock market jumps extremely high, and it's very hard to time that kind of thing? Eric.
Yeah, I'm sorry. This was for me. I apologize. I think I said Brian. So I would say this. We think there's likely going to be a real demand for buying stocks. And we've even seen days, Liz, like back on CPI Wednesday a couple of weeks ago when the news couldn't have been worse. And markets just turned and rallied. It was almost like that George Costanza moment in Seinfeld when he does the exact opposite of what he thinks he should do. Those things happen in markets. And so we think this is the environment where, look, before the Fed actually stops and reverses, markets will rally. So we think there's probably an opportunity in the first quarter to probably rotate back in more aggressively. But we still think the Fed, bottom line, they made it very clear today. They're going to tighten interest rates into a tightening and into a weakening economy. That is generally not a good setup for most sectors. So our viewpoint is that you have some time before that rally actually takes shape. We'd be a little more defensively oriented. And so again, our viewpoint is that, look, spend some time rebalancing portfolios, emphasizing short duration fixed income. Energy is a good spot to be. That rally will come, but it's not, we think, in the cards anytime soon.
Yeah, right now we've got Brent and crude moving slightly higher, but I really do not know what Powell is talking about. I mean, can you really say that energy prices have come down that much if oil is still at, just below $90 a barrel in the aftermarket session here? We're at $89.15. Brent, which is the international benchmark, at $95.47. So I understand that he's trying to say that some things have come down. And in truth, Dutch, crude had been as high as $128 a barrel. So, yeah, we've come down, but we're still so high.
Yeah, my question is this, and my rant is, when is the Fed going to understand that, inflation's not going to get to 2%? Okay, it's going to persistently be at 4 or 5, 4.5. Jeremy Siegel, who both Eric and I, took classes from, is basically saying that as well. And he's saying they've got to slow down and let things. This guy's killing us, okay? But he's not just killing us. He's killing the bond market. He's creating instability in the Treasury market, currency markets around the world. I mean, this has got to stop now, okay? He's got to slow down. He's got to slow down fast. And he doesn't sound like he's going to. And at some point, that push and pull between the markets and the Fed, he's either going to break things and the market's going to show him, you screwed up again, okay? Or he's going to have to slow down. And so we've got a real game of tug and war going on.
Okay, I'm just checking the 10-year because it had been about 3.99% before the announcement.
Okay.
We do have it now at 4.09%. Okay, so but before the presser, it was at 3.99. This morning it was at 4.02 or something. I mean, this is very interesting behavior, but talk about breaking something. I see a few fissures here. Eric, Dutch, great to have you both. Thank you very much.